Elon, here to take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade, on the website, tastylive.com, welcome. Join us in the chat on YouTube. Tell us what you're trading, what you think of this market. We do have a fast and furious rebound here for stocks, which after closing much weaker on Friday, did not see any overnight selling pressure in the European or Asian hours. U.S. traders were happy to pick up the baton and run this thing back up to basically where we were prior to the jobs report Friday morning. Your Russell is the leader, Mr. Radigan, up by 2.22%, followed closely by the NASDAQ up 1.95%, S&P up paltry, 1.58% itself. It's one of the better rallies that we've seen since late June. Dylan, I want to start with you at least here as we turn our attention to the stock market, because I did see a little bit of a walk and talk that you had today. Great video that you published to Twitter. Your optimism unbridled seems vindicated on this rebound Monday. Why is the market back up after such a horrific end to last week?
Overwhelming force of the glory of modern technology. It shall not be denied. It shall not be diverted. It may be occasionally delayed as a result of, valuation or some economic rationality, but that'll only be brief and short-lived. I just think that this is a tidal wave, a tsunami, if you will, an overwhelming force of optimism in technology that if there ever was a buy the dip scenario, I don't know about, again, the indexes, whatever, but for sure the NASDAQ, for sure Meta, for sure NVIDIA, for sure Google, for sure Tesla. Don't let me look at this. Don't try. What do you think? You're smarter than the, you're not, okay? Just stop it and just let it ride. You'll be fine. And so I think that, you get, that's what I said, this is one of those things where thinking hurts or hurts you. And so I don't advise it.
Oh yeah, to his point, Microsoft, new all-time close, Meta,
sure,
new all-time close.
Sure. No, I don't think you can in any way dismiss how forceful this rebound was. I just think you also have to acknowledge that this forceful rebound has only erased about 50% of last week's sell-off. So the force of the way down merits a strong rebound. There's nothing particularly surprising there. We've been talking for a few days about how last week the sell-off landed us on basically the important range bottom for pretty much every major index, where we might look and see, okay, if you cross this Rubicon, now you have a top. And now the bias is overwhelmingly turned. Let's see. I mean, in my mind, we have not overturned last week's sell-off. We've seen a correction to retest whether the sell-off has wherewithal to continue. Let's see.
Dylan, Friday's market was punctuated by a really deeply negative flavors of highs jobs report. A jobs report, when we take a look at the numbers, typically doesn't see that scope and scale of revisions outside of times of what, Ilya? Deep recession? We shared the graphic earlier on overtime today, but I suppose it's worth bringing up again here right now, so I'll do that. Dylan, did anything stand out to you about Friday's jobs report? We've had maybe the U.S. economy is resilient and humming along, and there's no reason to get too worked up. I can't help but notice that the 2-month revision that we just saw is the kind that you see during COVID, during the global financial crisis. There's a lot to discuss about Friday's jobs report, Dylan, but let's just start with the actual numbers itself and not the narrative elsewhere. Why does this not worry you if this is a data point that appears in
if you're looking for things to worry about, I would say that the list is as long as ever. Whether it's on the job, I think there's inflation concerns. I think there's job data concerns. I think China's more powerful than we give them credit for. I think that if the European Union was a federal state instead of a consortium, their leverage would be more than the United States, which is its own thing. There's a million issues But I just think that at this particular moment, when it comes to the financial markets, that the pure force of artificial intelligence as an investment hypothesis and as an economic phenomenon, that it's sort of like, the Buffett saying, when the tide goes out, you see who's not wearing shorts. Well, when the tide comes in, all the problems are hidden. And I just feel like that this is sort of a rushing tide of optimism and a rushing tide of technology that's coming in, which is not to say that I'm not concerned about the jobs number or not concerned about inflation, or I mean, I can be concerned about all of these things. And if I had Ilya's patience to sort of take these micro shorts, and then sort of just get ding, 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 and then when it goes my way, lean into it, which I have great respect for Ilya's ability to do that as a mental temperament. And I think that probably makes a tremendous amount of sense, but I don't have the temperament for it. And so if I'm going to do anything, it's long the Mag 7, it's long AI, and it's buy the dip. Not because I think the jobs number is not alarming, or that the decision to abandon the concept of data is not an issue, but simply that I believe that the force of artificial intelligence is that big that at least for the short and intermediate term, it becomes an overwhelming wave. So it's not that I discount the other issues. It's just that I believe the force of the AI thing is that big.
Well, you mentioned AI. We have Palantir earnings that have just come out here, and the market's taking them in stride. Sales up $1 billion versus an estimated $939 million, the first time that they've cleared $1 billion in sales ever. EPS 0.16, 16 cents versus 13 cents estimated. Their sales outlook, $936 million versus $899 million. They're looking for operating profit of $495 million versus an estimated $417 million. About 40% of the business is related to government contracts and AI, Dylan. So shares here up after hours from 160.66 close to now 167 and change, as it were. Dylan, I do need to pick your brain, though, because Ilya and I were on Friday, so we had a chance to talk about non-farm payrolls, but the firing of the BLS commissioner is eyebrow-raising for a number of reasons.
No kidding.
That's not to say that there are not legitimate complaints about how the data collection has deteriorated in recent years. In fact, in recent weeks here on the show, we've shared charts of how the response rates to various official government surveys have dwindled, particularly in the post-COVID era. Now, that's not the full story, because by the time you get through the final revision of jobs reports, you have 90+% respondents. But the initial responses, they've fallen. And so it's led to some concern about how actionable or viable the data even are. This doesn't seem like that, though, Dylan. It doesn't seem like there's a problem with the methodology here. I know that we like to rag on the plus or minus error term for the jobs report being 100,000, but the way that they measure the jobs report is they tally up all the jobs in the country. So when the difference is something between like 156 million 400,000 jobs and 156 million 200,000 jobs, that's an error term of like 0.16%. Like it's not that big in the grand scheme of things. So what does this tell you about the state of the US economy right now if we're firing statisticians for bringing bad numbers to the president of the United States?
I mean, first of all, I would say that the jobs number, for as long as I've been around it, which is probably 30 years now, God help me, has always been a squirrely number. Difficult to forecast. It is the very reason I believe you once upon a time texted me the words ape shit. Was that in the context of such a number? So I would say that the jobs number is obviously one of the most important, if not the most important number outside of maybe CPI, PPI, depending on what sort of is going on. And it's also one of the most revised. It's always been heavily revised. And it's always been, vulnerable to meaningful divergence from expectations. So I am not that alarmed by the presidential firing of a statistician on the jobs number, because I think the jobs number is always going to be the jobs number. I think that the presidential firing of the statistician is less of a reflection or honestly a concern for the jobs number and more just an indication to the temperament of the president. It's like the president fires the chef because he doesn't like the food. Well, there's still a kitchen and they're still going to make food in the kitchen, and it's going to be a different chef. Like, I don't think that one statistician, even one very important statistician, firing that person ultimately is going to have a material impact on the degree to which we have a reasonable amount of insight on the jobs market via the jobs number. Because I believe the jobs number is assembled through so many disparate, atomized parts and is so, as I mentioned, heavily revised as it is, that the president firing the guy I think it's dumb, but I think it's more of a reflection of the judgment of the president than it is a point of concern in my point of view. Maybe I'm naive, but I'm not worried about the quality of the jobs number. I'm worried about the quality of the president.
Could I opine perhaps on that whole, how the data are accumulated?
Please.
I think it's interesting for people to know that the BLS commissioner actually is not part of the process for tabulating the non-farm payrolls data. All the data, as Dylan just said, are atomized, and they're basically aggregated micro up. When the BLS commissioner herself or himself gets their hands on the report, all the data has already been entered into the official computers and has been transmitted out into the world, so it can be embargoed for various reporting agencies and news bureaus. And so when the BLS commissioner receives a copy of the jobs report that will ultimately be released on the Friday, she has a final number that she's going then to deliver to the president's council of advisors. She's just a messenger. She's not producing the report at all. But Dylan, I think you also raise a point there, and perhaps maybe this is the market rebound today. She's definitely not going to be firing Powell. Because if he's going to be firing the head statistician at the BLS, if he really thought he had the power to fire Powell, Powell would be long gone by now. Yep. Maybe that's what we're also reassured about today. Is that not a proper view to think about what just occurred here? Maybe that we don't need to worry about Powell's departure whatsoever?
Maybe. I mean, maybe. But I just think ultimately the markets, I'm a broken record right now. I think the market's behavior is propelled by the overwhelming force of the AI hurricane. And I think it blasts through all these things. I think, sure, not firing if you're looking for confirmation that the president, it's impossible for the president to fire Powell. This could be that. But Powell's done it in 7.5 months anyway. Like, it doesn't really matter. Like, the Powell's going to be done quickly, and you're going to get, a CNBC host as your Fed chief come 2026, probably Joe Kernan.
Oh, I was saying, are you going to throw your hat into the ring?
I don't think I'm qualified. I think I ask too many questions. I think you need somebody more obedient.
Oh, yeah. I would love to see a Dylan Ratigan run Fed.
Oh, that would be tremendous.
What's that?
Yeah. I'd love to see you run a Fed press conference.
Me? I would like to see Maria Bartiromo run a Fed press conference.
Oh, okay. Fellow Italian-American. I guess that's good.
Yeah.
Right. Okay. Response.
If I ran a Fed press conference, I'd be like, let's be very clear. Nobody knows. I don't know. No one in the boardroom knows. All the data are bad. The GDP number measures all of the wrong things.
Sir, ES minus 300 on your comments.
Never mind. Everything is fine. Everything is fine. Carry on.
Just kidding. Ilya, jump in here. There are obviously concerns about the BL, and I don't know if people are going to trust the future NFP numbers. Again, this is kind of like when I hear concerned about like state elections and whatnot from political people. It's like, that's not how elections are run. I know, I've partaken in the system. I've helped with the recounts. Like, it's an atomized system for a reason. A lot of decentralization means limited points of absolute failure. So what does this mean to you? Like, should we, as people have messaged me, I've seen been tagged in tweets, emails, like, should we trust data from the US government from now on? Or is this another tempest in a teapot?
There are two different perspectives here. There is the perspective from sort of generally the chilling effect that this produces, in the sense that, you know, if you bring the monarch bad news, beware, your head may be rolling, and that doesn't necessarily compel then the monarch to act. It creates a sort of incentive, and then you start to wonder if in fact the data is getting massaged. And there's a gazillion things you can say about that. Obviously, examples of Turkey come to mind, etc. But I think the most important example from a trading perspective is the example of China, where the massaging of economic data is so open, so readily discussed, so easily telegraphed by officials, that you can actually get an example of what that looks like in practice, and the markets take those data at face value. Why do they do that? Because they need a jump-off point, they need a reference point, and very simply put, either the data is real and that's a policy signal, or the data is cooked and that's a policy signal. From a trading perspective, what you need is the policy signal, so that you can understand how then assets may respond. So from a trading perspective, this doesn't change anything for me. Nor do I think is it going to change anything for anyone, because what they need is a baseline, not the absolute academic accuracy. They need a yardstick against which to trade.
It's kind of like the Nielsen survey data for watching televisions, Dylan. It may not be the most complete set of data, but because there is a set of data that has been built up, a process that's been upheld, there's been buy-in, and a lot of people use it as a reference point.
Mm-hmm.
Like, that's what really this all underpins, is that all of us are looking at the same information and it's all publicly available. So,
and at least it can be directionally, even if the levels are all wrong, at least we know that it's sort of all consistently wrong in the same way, such that the direction is valuable.
Well, and everybody is looking at the same wrong number or right number or whatever number, and then benchmarking their actions against the same thing. As long as the game is in reference to one variable and everybody has said this is the variable, now let's go value assets, that's what matters.
I mean, I think that's ultimately what we as traders need to be concerned about within this story at the moment, right? Maybe the underlying data, we're going to question it. Some will, to a higher degree. Perhaps that leads to more volatility, but we're all going to be looking at the same number. We were all looking at the same number in July. We're looking at the same number on Friday morning. If the next number comes out and it says plus 200 with the revisions of plus 200, we're all going to have to make the judgment around whether or not that's a number to trade around or not, just like we did every other number.
We just learned this about CPI. The Wall Street Journal just had their big article about CPI and how the share of imputed data points in CPI, that is those things where they didn't exactly observe those data points, but they imputed them, jumped to 30%. And that's higher than COVID, even when everything was absolutely shuttered. Why? Staff cuts.
Well, yeah,
they're
staff
just not
cuts.
collecting the data. And
well,
so
that's Doge for you.
So you can talk endlessly about the strangeness of saying let's fire the head of the BLS when the data is volatile, when it's the staff cuts I've mandated that make that data volatile, like it hasn't been before. But from a trading perspective, does that matter?
No.
Not really.
No, that's really what I wanted to get to here, because it's a lot of narrative and noise, and there may be some other implications for it. But from our perspective, the data is the data, right? We're all going to be looking at it.
Yeah.
Dylan, I saw this Reuters article last week Do you notice when it's dated? July 25th, 2025. That's before Trump fired the BLS commissioner. So this has been something that people have been talking about. If you were to scroll through the article, which I'm not paying for Reuters here on this login, you know what? You would see that people have been saying, yeah, there's been this trend post-COVID where response rates have fallen across the board for the initial data. By the time you get to the final revisions, most of the surveys are in there, but how come people aren't responding in a timely enough fashion? What can we do to get a better system? And so Trump doing this right now, yeah, it's ugly, particularly after a bad jobs report. He was cheering on this one 2 months ago. Last year, in terms of revisions, there are 12 revisions. 6 were up, 6 were down. Like washes away.
This is like the most revised. This number's been getting revised for decades.
Because the first iteration of the report, we only have somewhere between like 65 and 80% at the high end of people responding to the survey. And by the time you get to like month 3, one of these small businesses that doesn't have an HR department, but like it's the owner following up on things, like that's when they get their payroll information in. Now, are there better ways to do it? I'm sure. We probably should be looking, how can we do weekly jobless claims, right? Like, aren't those payroll figures? There may be other ways to collect the data that we need to make these informed decisions, because at the end of the day, that's what this is all about. We only care about the non-farm payrolls number because it helps us understand the state of the economy. It feeds into our understanding of where policy will be. If we're growing, we're shrinking, should we be adding more in stocks or bonds? But otherwise, it's just a number, right? As traders, we don't really care about it. It helps us with our asset allocation preferences and maybe nothing else. So Ilya, I'm not of the place, and Dylan, I suppose with you, after giving this a few days to settle in, we're all going to be seeing the same numbers, real or fake. Doesn't matter how you feel about them. We're all going to be trading around the same number, no matter what. So as a trader, I don't know if this story matters much at all.
I don't think it does. I mean, it's just, I think I said more than enough about it. What the question that comes up for me, just to go back a touch, even going back to when I was at CNBC, for sure when I was at MSNBC, all of the data is lousy. All of it. It's relevant and valuable for the reason that you articulated, which is at least it's a shared, common, lousy data set that is indicative of directions, expansion, contraction, rising, falling, whatever. But I do wonder, Ilya, in the scope of sort of generally lousy data, either measuring the wrong things, like if a hurricane destroys a city, that's GDP positive because there's going to be so much money spent on construction. So that's good GDP, but why is that good for a society? Or if a mad lunatic runs around New York breaking everybody's arm, that's good for GDP because it creates an increase in medical spending. But is it good to have somebody running around New York breaking people's arms? And so there's sort of there's the phenomenon of measuring the wrong things and saying, well, it's valuable to have lots of broken arms and lots of destroyed cities, which I think we could argue maybe it's not. And then there's sort of bad measurement, right? Like they don't even know, right? Like it's just it's some technique from 1923, something like this. In the scope of sort of good and bad data, and for me, the jobs number, the reason I actually like the jobs number is because it does get revised. At least the jobs number, they're like, this is what we think. But honestly, give us a month because we're going to have to sit with this thing and we'll let you know. And that's why like this month's revisions of last month are frequently more interesting than whatever the headline is.
That's right.
Month. How does the CPI and PPI shake out in the scope of lousy data? Is it among the better or the worst indicators, in your opinion, relatively to your experience, all the data that exists?
I mean, I think...
Are we getting a good reading on inflation? I guess is what I'm getting at.
I mean, I think what a lot of people always quibble about with the CPI and PPI data is what's in the basket. Because really, inflation can only be sort of discerned, or at least we've decided that the way that we're going to discern inflation statistically is come up with a basket of stuff and track the cost of the basket over time and then get a sense of what inflation is that way. And periodically we tinker with the basket because, of course, that makes sense. The sort of range of things people consume. That's going to change when people get in cars or a cell phone is invented, etc. So you constantly have quibbling with what's in the basket. But I think from a trading perspective, again, the most important thing is to have a jump off point. We can absolutely have an academic conversation about whether it is, let's say, as you were saying, a good thing that after destroying a city, first GDP would crash, and then it would violently rebound as that city is rebuilt. Is that a good thing? Whether it is or not is a point of policy. For traders, what matters is that there is a number against which they can say, well, if this were this to be a real number, assets would be this. And then there's another group that says, well, no, because this number is going to go there, so the assets should be that. As long as both sides of the market are jumping off from the same number, its academic quality is not relevant very much. At least that's what we've learned about China, where the numbers are very suspect a lot of the time. But the market just says, well, but I just need a yardstick. And if we're all using the same one, we can value assets to the best of what any one of us ostensibly could know.
And even the worst numbers, to Chris's point about the Nielsen ratings, can be directionally accurate.
Yes.
The audience is getting bigger, the audience is getting smaller. The prices are getting higher, the prices are getting lower.
Yes.
There are more people that don't have a job, there are less people that don't have a job. Like,
absolutely,
just that one statement has tremendous value.
And things are going faster, things are going slower.
Exactly.
Things are accelerating, they're decelerating.
Exactly.
In a good direction, in a bad direction. All of these types of dynamics are really what markets are after. And so whether the number is what it is to the exact decimal point or even to a significant degree, from the market's perspective, that's not what's important. It's, are we all valuing the same thing? Mm-hmm. Is the bogey the same for all of us?
Mm-hmm.
You know, you talk about data reliability in China. I recall reading a story last year, and I was reminded of it on Bloomberg Radio today. There was a researcher at the University of Wisconsin who had come out and said that China's population was being overstated by probably 100 million people, maybe a little bit more. Mm-hmm. And maybe it was Morgan Stanley then produced a follow-up to this. Like, what would the implications of that be? And they basically pointed like, hey, you know, if that's actually true, that would explain why their economy is not growing as fast as we think it should be, given what we understand to be their official population data. Right. Because it's like, oh, if there's 100 million fewer people, oh, okay, that explains why aggregate demand is so much lower. It's not just they're doing a bunch of policies that don't work. They're not actually pumping as much money into the system on a per capita basis as they said. Maybe they're doing it at per capita of 5,000 yuan per person, mm-hmm. but there's that many fewer people than we anticipated. So there's not as much money going throughout the economy.
Right.
So data reliability is a problem. You could talk to anyone in Europe. Eurostat and the European statistics agencies don't hold a candle to anything that we do here. But as traders, we're all chasing the same object. It's different for CPI because CPI is more of like a measurement where they go into establishments. And I think the basket point, Ilya, is well taken. We should be quibbling over what's in the basket.
And boy, do people. I mean, the whole concept of the trueflation measure that comes up every now and again. I mean, what is that? People go, well, inflation isn't really this, it's that. What is that statement embody? It's quibbling over the basket.
Right. And trueflation is measuring millions of data points across the country in real time, so they say. CPI is very similar. They go to retail outlets. They basically 55-60% of the survey is done by actual, canvassers going into stores and collecting information on prices. And you understand why there's not a revision then, because after I've seen the price of something like today, this is $3.99. I don't need to call back the store and be like, can you confirm that this was $3.99 on August 4th? Like that price didn't change intraday on August 4th for the cup of coffee. So the price point is the price point at that moment in time. In any event, it's only about 80,000 prices in the top 75 urban areas in the country, which 75 urban areas in America, what kind of small cities are we getting into? Like the Yonkers, New Yorks of the world, Dylan. Small places. So it's not just the New York Cities, the Miamis, and the San Franciscos that garner all the attention. Either way, though, I think we've talked about this enough. We can move on to a different topic at this point in time.
Can I just make one comment on this? Although hopefully,
sure, no, go for it. I think this is interesting.
I do wonder. So let's say you have one number that's a lousy number.
Well, Dylan, hold on a second. Can I say why this is important? We're all left-leaning people. Our audience, we know that there's a lot of people who are like us, but more market-minded than your average, Democrat bear. And I try to be apolitical as much as possible. We want to analyze things through a policy lens, but I've just seen the information that's being fed to, like on CNN about this. And it seems to me that from a trader's perspective, you could really get lost in the sauce, conflating actionable information and things that would force you to change your trading mechanics. And I don't think this rises to the threshold of that. I think it's our job to provide that clarity for people.
Yeah, no, I mean, I think it's easy to be like, oh my goodness, now the data, now we don't have data anymore. It's ridiculous, honestly. But what I was reflecting on and listening to this discussion was the sort of the mutual decision to agree to use the wrong number makes the wrong number right.
Yes.
And so let's say you have this New Year trueflation number that is a better measure of inflation. Mm-hmm. In some sort of academic audit of sort of the components and the way it's measured and whatever. But are you going to trade based on the delta or the spread between the trueflation number and the CPI? Because my bet is that the CPI number you'll get run over every time. Like that if you think you're going to outsmart the bond market using a more sophisticated inflation number than using CPI, I think you're barking up the wrong tree.
Well, and moreover, if you're looking at a number that's maybe more right, if whatever that means, but if the central bank is going to move on what the official number is, what does it matter that you're right about inflation? From a trading perspective, you're not trying to be right about inflation. You're trying to be right about what asset prices are going to do.
Yeah.
Right.
What does it matter?
Unless if the market doesn't believe the data, it's not going to be a scenario where it's like, oh, inflation came in right at 2% on the nose. And the market freaks out and goes, oh, no, it's really XYZ. And then everything sells off. It might be a situation where everyone just goes, we'll wait for ADP.
Yeah.
We'll wait for the ADP report.
Hold on.
We'll wait for the jobless claims because those are aggregated from the state level up. And, the 4-week average of jobless claims and that rate of change has been a pretty good predictor for recession. So who cares? If the economy isn't growing and companies are losing jobs, we'll just see it in those states' claims data. So like we can't rebuild them perfectly, but we could do it in aggregate. And again, I don't know what this does to move the needle for us as traders. It's an interesting story. It's been dominating the financial news wires. I felt prudent for us to address here today. There's a different story addressing things that are important in terms of locking people up. I don't know how I transitioned with that. Elon Musk is staying on with Tesla.
Well done.
For the next few years. Tesla's share prices were up 2.19% today, Mr. Radigan. We see that the board has approved a $30 billion stock award to Musk as long as he focuses on the company. Is this the most important corporate news of the rest of the 2020s, that visionary Elon Musk is now going to be focused on electric vehicles and AI?
For sure not. I mean, first of all, just because he's committed to do something today doesn't mean he'll do. I mean, you know, this is not someone who is beholden to contracts or money. So just because he made the deal today doesn't mean, you know, that the deal is going to be good in a year or two. Although I think it's the right deal for Tesla. But I think the question is less Musk, not Musk. The question is, what is the best way to be invested in artificial intelligence? And is that Tesla, or is that Meta, or is that Microsoft, or is that Google? And it might be Tesla. It might be Tesla, because at Tesla, you get a sort of 2-for-1 special of both artificial intelligence and transportation technology. Not bad. Musk, I feel like, has almost moved into a character who obviously has great value and all the obvious things. But I think the greatest value at this point is that I think Musk is going to become less damaging. It becomes more of a do no harm thing. Like, the more Elon Musk is not a central figure in American or global politics, the better off Tesla shareholders are. And so I think that's actually the most valuable aspect of all of this. But I mean, I guess the question I would assert to both of you,
inverse key man risk.
Yeah, do less, bro.
Okay.
Why don't you just calm down? Just calm down. Everything will be just fine. But my question for the two of you is, if you have to rank the AI names for the most desirable to least, between Tesla, Microsoft, Google, Meta, and NVIDIA, so those 5, let's say, how do you stack them with your grandma's money?
What's the time frame? I think is the most important question to answer there, because
let's say over the now, let's say 12, not a trading time frame. Let's say it's like a 12 to 24 months.
Tier 1, Microsoft, Google, Tesla.
What was number 1?
Microsoft, Google, Tesla. I think it's so. I don't think Musk is going to keep XAI. NVIDIA would be tier 2, because I think that the applications are that's going to spread, but NVIDIA is going to stay near the top because inference is what drives the demand for the GPUs. So this is a snowball. The more people use it, the more inference, the more viable it becomes, because the greater the use cases become.
Why Microsoft instead of Meta for number 1?
Microsoft has done a very good job, I think better than Meta has, at managing its risk in the space and not overbuilding. I also have seen some comments made and have verified myself. Meta has done some interesting classification on their income statement in terms of how they're depreciating their GPUs. That's to say that the GPUs typically have a depreciable lifespan of about 2 to 3 years for actual use, and they're marking them off as 10-year depreciation on their income statement. So it seems just like there's a little bit of, I'm not accusing anyone of any wrongdoing here, but it seems like they're trying to tell the best story possible, right? And they're telling the best story possible that they could be telling right now with the numbers that they have. So in terms of running that narrative up more and, gilding the lily there, I think the lily's already been gilded for Meta. But Microsoft, to me, they can just keep going. And they have the consumer scale that so few other people have. If it's what's happening with your phones, operating systems, computers, cloud software, that was Amazon's reason for being punished. They don't have the software, they don't have the scaling in cloud the way that Microsoft does.
I don't know.
Ilya,
to me, it comes down to valuation, because I think the space itself is so saturated that you look within it and you go, okay, Tesla has been beaten down a bunch and Apple has been beaten down a bunch. Both of those offer you some, if what you believe in, which I don't, is rotation inside this space, because there's general strength and there's going to be catch up because everything is going to work out and everything's going to be fine, then the laggards are Tesla and Apple.
Mhm.
And so that's where the value is.
I have such a hard time, Dylan. Apple here. I know we have a bit of a rebound today, but Apple is not a participant the way that a Google, a Tesla, a Meta, a Microsoft are.
Causes me sadness.
I'm just shocked that they blew their first mover advantage with Siri. And how do they get out of this now? We're tariffing India. The whole plan was to move production out of China into India. Now we're going to have tariffs in India. Like, what's Apple's path forward right now if they don't have a premier AI offering?
No, I think that's the question you and everybody else on the earth is asking.
They have the premier delivery system, regardless.
But they don't have a product to deliver.
They are the product. The ecosystem is the
I agree, but
product.
But they don't. But when in a world where Apple has control of the dashboard, the physical hardware that is the dashboard to the digital world, but they don't have the AI.
No, so they're gonna need to figure out how they're gonna sell being the middle step, and what deals they're gonna cut with those
With
places
Microsoft
where there is
and
AI.
the other guys you're saying?
Yeah, I mean, I think right now, and this is not my wheelhouse. I look at the world through a macro lens, but if I had to kind of dabble in company level thinking, I would think that for them, they're going to have to figure out how they're going to sell being the delivery system, and say, you know what, for us, that's actually better because we don't need to win the AI race. We just need to take the piece of monetization from whoever wins and let them beat each other up. We'll just sit here and get paid either way.
Maybe.
And multiple on that is nothing like the multiple on AI. I mean, that's a bad day if I'm an Apple shareholder.
Can we point out something good that Apple's doing though, which is just delightful? This was forwarded to me yesterday. It is, and it's not downloading. Please download. Okay. This was forwarded to me yesterday. It comes from the National Republican Senatorial Committee. It's about political texting. Apple's releasing iOS 26 in September because it's the next iteration of iOS. You know what the good news is? It doesn't really matter that this is from the NRSC. If it came from the Democrats, I'd show it here too. There's going to be a separate inbox for spam messages now. So we're
I have it on my phone already.
I don't have it at all. So I'm so looking forward to.
I have it on my phone already.
28 texts a day.
The Mail app on iOS now categorizes separately spam, separately updates on any shipments you might have coming in, separately on this, separately on promotions.
Doesn't Gmail do that right now also?
And then your real email.
Gmail does.
Yes, Gmail
I find
does.
it annoying.
It depends if it's done well, and I think that this is. I find on Gmail it is kind of annoying, but this version that Apple has created is actually pretty convenient.
Right.
I signed up for a group a number of years ago, and it's very obvious that they sell their list to Democrats and Republicans because I get like 20 messages a day from both parties. It's like, please stop. Please stop. And now I'm starting to respond to the text messages angrily. Like, there better be a human reading this because I can't do it anymore.
So don't you just have to say stop?
You know, that's the funny thing. I send stop. I click delete and report spam.
There's always a new one though.
It's happening. They just keep like the zombie invaders keep.
Well, it's like, yeah, the phone number is always like 833-411-1234. And then I block that. It's like 411-1235 shows up next.
Yeah.
It's like, I didn't block that number too. Okay. All right. Dylan, this week.
Amazon chart. That's not pretty.
Well, you know, that's because they're not doing well with their AWS and the numbers that they laid out. They're not getting the traction that people thought they would. But I suppose the question is this a buy the dip opportunity, Dylan? Because you are ever the AI optimist. It subsumes and consumes all. You're getting ready for the singularity. Why not roll the dice on another one of these companies like an Amazon? Or is
100%
this?
agree. Couldn't agree more. At least do some put spreads.
Do you think that the U.S. consumer is a bigger problem for Amazon than the AI story?
No, but maybe the tariffs are. And the de minimis and all that jazz. But anyway, no. AI, yes. Buy the Amazon. Don't be an idiot.
He makes it sound so simple. We've continued to rally here after hours, by the way, with Palantir's beat. NASDAQ is now up 2% on the session, 23,340.50. S&P extending gains 63,67.25. Ilya, I try to be, I'm not always, but I'd like to be a man of intellectual integrity. Earlier today on Futures Power Hour, NASDAQ level was 23,300, Russell 2210, ES 6365. We're through those now.
Yeah.
Is the correction over?
I don't think so. I don't think we've come back through the underside of former support, become resistance, and we'll see. Maybe we will, but we haven't yet.
Dylan, what will happen first? S&P 500, 7,000, or Ilya turning bearish?
You mean bullish?
Really turning bearish?
Bullish, excuse me. Because it seems like that's a long way away, but it's really not that long away. I mean, Ilya, the line that we had
So
here.
Ilya turning bullish, or what's the alternative?
S&P 500, 7,000.
S&P 500, 7,000.
10% rally from here.
S&P 7,000. Ilya is biologically designed not to be bullish, and there's always an abundance of reasons not to be bullish. And he's comfortable with his little micro shorting strategy, and he's done very well with the currency. So he's not sweating his chicken soup. So there is no way this guy's going to be bullish ever.
Ilya, I have to say,
in fairness, I did buy the early April low, but I was in there lightning fast.
I mean, it's antithetical to his Russian heritage. They're known for their dour and bearish worldview.
And my first trades was were done in 08. I'm conditioned.
And the icon of Russia is the bear.
What I'm getting at here is I'm looking at this, and what appeared to be a breakdown earlier today has clearly moved in a manner where that needs to be questioned. If it is the Russell back above 2210 or so, if it's the NASDAQ back, I mean, we're about to clear out that swing high we talked about earlier on Futures Power Hour. Same thing with the S&P 500. It's already kind of poking through there.
Yep.
Where does this leave us heading into tomorrow?
Obviously, we have had a spirited rebound on Wall Street. I think it's very likely that, as you usually do, whatever happens on Wall Street becomes a tone-setting situation for Asia and becomes a tone-setting situation for Europe. I don't put a tremendous amount on what's going to happen in that sense on anything until we get to about midday Europe, where the U.S. Volume starts to build and we start to get the overlap between Europe and the US. We get some real liquidity. We see what this thing is made of. We may well test deeper higher here on the futures. It's thin. Asia's going to have to respond. All that makes sense. Now, if for some reason this thing fails in Asia, that would be very soft-footed indeed. But I don't think that's going to happen here. I think we're going to see a little bit of follow through, and when we get to somewhere within striking distance of U.S. market can open, then we'll decide.
Dylan, with that, I think we should leave that session here on the cutting room floor for today. Overtime is out of time for this Monday, August 4th. We'll be back tomorrow, same time, same place, every Monday through Thursday, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak and Dylan Radigan, I've been Chris Vecchio. Good luck trading. Grab a bite to eat, something to drink. As Dylan might do, have a cup of coffee and a cigarette. Then come back for Ilya because he's
Way
here
to
with
go.
macro money. Oh, good for you. Good for all of us. See you tomorrow.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily, covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
With rate cuts back on the table, are there any trades that you're watching in particular?
Well, rate cuts have never been off the table, but every time bonds drop, I think they're a buy.
Not really watching any specific trades in the interest rate space. I do keep an eye on, the futures options like the ZBs, the ZMs, the ZTs to see if there's any volatility types of plays that I can integrate into them. Unfortunately, I don't really feel like there is a really great micro future to trade the changes in interest rates just yet. I feel like they need a little bit more volume, but when those get a little more active, that will be definitely one way I will be participating.
Yeah, I am. I would say honestly the dollar trade, and I know that is one trade that has been very crowded as far as a lot of people are short the dollar. And if you look over the last couple of years, typically when interest rates are higher, the dollar is higher, and we've seen the opposite. So it would definitely be the dollar and how I'm going to trade that based on what happens with rate cuts.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The future of trading is here.
Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Well, the markets find themselves a little bit of steam for a rebound after last Friday's bloodletting. But is it the start of a recovery, or are we in fact looking at something more sinister once this rebound runs its course? That's the question we're going to ask here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here is explore how all of this might play out in the week ahead with a much lighter calendar of scheduled event risk on the menu and a lot more opportunity for the markets to sort of find a path of least resistance. We'll start with a look at where the performance situation left us last week and go from there. This is what these markets did ultimately once the dust settled on Friday's volatility. And what we see here is, of course, very, very lopsided. We have dramatic declines last week in both the S&P and NASDAQ. That comes with a drop in yields, which of course is more intense at the front end of the curve than it is at the back, because all of this ultimately comes together as a consequence of a very disappointing jobs report, perhaps not even so disappointing at the headline, 70-odd thousand versus 110 expected. That's not that much delta, but dramatic revisions to the prior 2 months reports, to totaling a downgrade of 258,000 jobs between those 2 months. So cumulatively suggesting that indeed the economy is in much worse shape, or at least the labor market is in much worse shape than prior data suggested. Lots and lots of hand-wringing around that, of course, after the signaling from the Federal Reserve suggesting that they were not wanting to jump the gun on rate cuts. But of course, the markets then looking at this data and saying, well, you will be compelled. And so the response, both disappointed from stocks about the state of the economy, but also because of now the missed opportunity to cut rates in July, and perhaps now a elongated period of delay. The next scheduled Fed meeting is in September, where they might do something. And of course, the odds of a move there have now jumped up, as we can clearly see in what the 2-year does here. Interestingly, crude oil manages to rally on net last week. It's sort of off on its own as we digest still in the ranges that have persisted over recent weeks following those spikes around geopolitics in the Middle East. Gold a little bit higher last week, 1.9%. Most of that move scored against the backdrop of this drop in yields. But the really interesting story here, aside from the Japanese yen, where losses are relatively mild because of its sensitivity to yields, the situation in the euro here, the other major counterpart for the US dollar, pointing to a nearly 2% decline. Now, that's not as bad as it was until this jobs report came out and gave the dollar a big knockback last week, but it showed very, very spirited recovery last week until this jobs report. And certainly the more hawkish Fed didn't hurt the cause there, but the situation very interesting now for the dollar in that it's at something of a dividing line, as are stocks. And the question going into this week, of course, is will this momentum carry us forward, or is this move already spent? Now, of course, we can see the implications. The outlook for Fed monetary policy now in Fed funds futures envisions 5 rate cuts between now and the end of next year. The most interesting influence, of course, last week here was the jump from basically down to 1 rate cut for 2025 after the Fed, going into the jobs numbers, back out to a pair of rate cuts, 55 basis points now on the menu, basically in line with what the Fed has been forecasting itself. It's looked for 2 rate cuts this year. The real disparity then is next year. The markets are looking for nearly 3 rate cuts, fully discounted here. There might as well be 71 out of 75 basis points already priced in. That's basically a rounding error. So we're looking at a situation seemingly here where the view for next year is a lot more dovish, even though the view for this year has basically lined up. The Fed already discounting these 50 basis points for this year in their forecasting, but only looking for 25 next year, which of course is a huge 50 basis point disparity with what the markets now see. Clearly, some sort of a growth risk continues to be on the minds of investors. And so with that in mind, the first piece of interesting event risk for the week, sparse though it is this time as compared to last week's avalanche of news, we are going to get to the service sector PMI reading from the Institute of Supply Management. The expectation here is that we are going to see a little bit of a pickup. This would be the second consecutive month of growth. As ever, these are done around an axis of 50, where that's neither growth nor contraction. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so for the services sector here, which of course is the lion's share of the U.S. economy, a second consecutive month of improvement after that shock contraction back here. And with that, we have a acceleration. So seemingly a benign set of numbers, but of course last week we pointedly had a disappointment on the manufacturing side of the same survey. It was expected to be in contraction territory narrowly, but not only did it not manage to meet that, but it actually deepened into this this shrinking territory. The pace of contraction actually accelerated. So the risk here, perhaps, that services may go the same way. Now, a parallel PMI survey from S&P Global did suggest a buoyant service sector in July. So at least leading in from analog type of business survey data, we're looking at indeed a case for a bounce. So perhaps that's less market moving in that this much ought to be relatively discounted by markets already. The worrying bit would be if the internals start to look similar to the kind of thing we just saw in this manufacturing side of the equation, because of course here we finally started to see that contraction territory, new orders, and employment, and indeed in the case of employment, the contraction there has only accelerated in recent months. But not only did we get this deepening contraction in overall activity, but we had this overhang from the prices component. And of course, with the tariffs, that makes quite a bit of sense. But notably, over the past set of numbers, the prices component on the manufacturing side started to fall off, suggesting that with the tariffs notwithstanding, weakening demand is starting to weigh. And we are starting to see that really become a more cyclically worrying state of affairs, whereby whatever one-off factors happened here with this jump in the pricing structure, not surprisingly, it starts right going into the beginning of the year with the new administration coming in. But we are getting through the point where we have that one-off shock, and perhaps getting into the part where the demand destruction becomes actually evident. And as ever, manufacturing is a little bit more cyclically sensitive than services. So if this is suggesting to us which way the wind is blowing, then we may have a little bit of an issue on our hands here with this ISM report. Later on, we are going to get a monetary policy announcement from the Bank of England that is expected to give us a rate cut. And as we can see here, over the past several meetings of the central bank, the path implied in markets hasn't really changed very much. And what that seems to be suggesting is that expectations are relatively well benchmarked for what this outcome is likely going to be. Now, the expectation is that we're going to have a 7-9 majority on the policy setting MPC in favor of the cut, that we're not going to have any votes for a hike, and that 2 people will abstain and vote to keep things unchanged. Now, that's basically an inversion of the count when we looked at it for the last policy meeting, where there was a narrow minority wanting to cut 3 out of 9, but then 6 out of 9 voted to keep rates unchanged. So it looks all relatively steady, and with how narrowly these implied curves are sitting to next to each other, it seems like there's not that much room here for a change in the market's perspective. But of course, that also creates the threat of complacency. And as we can see here, looking between now and the end of next year, the Bank of England is expected to deliver 58 basis points in cuts. So one more cut this year with some possibility of a second, and one cut next year with some possibility of a second. So we're sort of veering into the between 2 and 3 cuts now through end of 2026 kind of territory at 58 basis points, narrowly. And so the surprise risk here, of course, would be any kind of a growth assessment from the Bank of England that suggests, well, we are actually perhaps more concerned or maybe less concerned about growth, and the overall tally, despite sort of how well telegraphed this particular move looks, perhaps the overall tally now is off. And with that in mind, we have an interesting story here for the British pound. So this is an excellent kind of version of what we just saw with the dollar last week. It had a strong push higher here, in this case against the pound, and then Friday's jobs report saw a strong rebound, but we pointedly held this former range bottom and held underneath it. So the breakdown architecture, as it were, seems to still be intact. And if we get a Bank of England that perhaps starts to get a little bit more concerned about growth dynamics and give us a sense that we are looking at maybe a little bit more easing against that back story than is currently being priced in, that may help to sort of engineer this rebound in at least the idea that at this point a reluctant Fed, despite the jobs data, is not scheduled to do anything until September, with lots of data in between now and then. And in that time, the dollar continues to be the higher yielding of the major currencies. Unless something materially changes in the outlook for, say, the Bank of England this go-around in a more hawkish direction, that still makes the dollar appear relatively attractive, and maybe that helps to make this a correction that becomes a selling opportunity rather than the other way around. Now, thereafter, we are going to be looking at a set of import-export data out of China, and here the expectation is that on the export side and the import side, we are going to see slowdown, down to 5% year-on-year on exports. We can see then that this upswing around the beginning of the year and the front running of the tariffs continues to fade. Meanwhile, imports as a measure of domestic demand, or at least a window into it, that continues to be anemic, and the expectation is we'll actually get a 1% contraction this time. That, of course, continues to speak to this larger narrative that we've been observing in China, whereby for 9 consecutive quarters now in China, we have had de facto deflation at the economy-wide level. And in fact, in the second quarter of the year here, with the latest Chinese GDP numbers, we've seen that deepen more so than this entire period, suggesting essentially that there is a near total absence of demand in China's economy, and thereby the whole of output, as it were, is on discount. And so we're looking at an economy that, were there to be a downturn elsewhere, were the U.S. economy, say, to lose steam, the world's second largest economy would offer no real backup. In this sense, a similar story for the Australian dollar as a kind of barometer on global commodities demand. And of course, China is its largest export market. And so there's some direct sensitivity there. We can see similar to what we just saw for the European currencies, a strong bout of US dollar strength, a very tepid attempt at going the other way on the jobs data, and then ultimately a situation where the former range seems to be getting retested, but the architecture of the breakdown appears to be intact. And so if we were to get a soggy set of Chinese figures here, sort of reinforcing which way the wind blows, seemingly since we established this top near the 66 figure, this might start to look like an opportunity for a trend that's developing rather than the start of a rebound in the opposite direction. And then finally, there is, of course, the implication for why all of this ought to come together as we consider what it means for stock markets and for sentiment writ large. We're looking here, of course, at the breakdown for US GDP data over the first half of this year. And as we've pointed out here over and over again, there is a tremendous amount of fuzz around the surge in imports in the first quarter, and then the retrenchment there in the subsequent quarter. There's a similar thing with inventories, where first there's a surge in inventories, and now it looks like those inventories are getting some degree of drawdown in the second quarter as companies attempt to shield consumers from the cost of tariffs. But the big part of this story is this right here: the shrinking contribution from consumption, because that accounts for 68% of overall GDP, where this is all, for the most part, noise. And what we find is that in the first 6 months of this year, we have the weakest 6 months of consumption contribution since the first 6 months of 2020, which of course is the COVID-19 recession. And so what ultimately brings us back to why the markets performed this way when they saw that jobs data is the implication that were we to see the US economy slow in a material way, as these GDP numbers seem to imply, as perhaps the jobs numbers suggest, as the ISM numbers may start to signal, this recipe for global economic resilience, whereby we have the world's top 3 economies accounting for 58% of global GDP, the US, the Eurozone, and China, are set up such that the US is where the growth is, and everywhere else remains anemic, then this is a single point of failure. And if, in fact, the US economy is starting to unravel from this, then there is no backup. And there is then a global and not just a US recession risk. And then, of course, those Fed rate cuts can't come soon enough. And so if, in fact, the Fed is resistant and growth in the US appears to start to sour, then this starts to be a lot of what is perhaps on the menu going forward, whereby risky assets take a haircut, interest rates continue to decline around swelling expectations, as we've seen, that the Fed is going to have to be more aggressive, if not this year, then certainly next year. And that may start to undermine the kind of resilience we've seen in cyclical assets, for example, crude oil. And then, of course, the most important question here for the dollar will be, is it a creature of yields or is it a creature of risk aversion? Because even with this decline at the front end around these swelling rate cut expectations for this year, overall, it has held up quite well, suggesting that maybe the dollar is regaining that risk-off haven of liquidity function and could rally even with stocks declining as growth expectations fizzle and yields fall. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also on with Chris for Futures Power Hour Mondays and Fridays, on with him and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Thanks for watching.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade. Tom, when you talk about the good guys, who are they?
They are us. We are the good guys.
When you say they take out the weekend, what does that mean to you?
That means when you're a premium seller and they take out the weekend, that means that all the decay over those 2 days, Saturday and Sunday, when the markets are closed, come out of the market Monday morning.
When I say bell to bell, what does that mean to you?
Bell to bell is like, in horse racing they would call it wire to wire, and in trading they call it bell to bell. So the opening bell to the closing bell.
If you're saying something's thin, what does that mean to you?
That means it's not very liquid. That means that the marketplace is relatively illiquid. That's what thin means.
If you can't buy an uptick, what's happening?
If you can't buy an uptick, that means the market is going down and there's no bounce.
How does Daddy do it?
Daddy does it good.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Crypto Show, I'm Ryan Grace, and with me today, of course, the wizard is in the house.
You.
Katie McGarrigle, what's going on?
I'm good. I was just telling you off air how I am still recovering from my bachelorette party this weekend. I have some very, very good friends, but my body does not heal itself the way that it did in my 20s, to put it gently.
I can understand that. Did you have a good time? What'd you do?
Had a great time. Yeah, we stayed in Chicago. We did this like really cool sneaker decorating class down in Pilsen at this woman's like shoe shop.
Okay.
So that was like really neat. And I'm like doing the artsy things like that. And then we did lunch somewhere, and then we kicked it for a little bit, and then we had like this mobile hibachi guy come, and like I was like playing with fire. It was kind of scary. Glad all my hair's still intact. And then we ended the night with dancing at one of Chicago's great dance bars. So yeah.
Hell yeah.
Yeah.
Sounds like a good time.
It was a great time. I just, again, like.
Very wholesome, Katie.
It was pretty wholesome, yeah. There was no...
sneaker decorating. I like that.
That's
That's on the other end of the spectrum from, I think, your traditional, well, bachelor party for sure. Maybe bachelorette parties are a little bit different.
Yeah, there were no, Thunder from Down Under, male reviews, or anything like that. Not that there's anything wrong with that.
Sure,
Totally
to each
support
their
it.
own, yeah.
Yeah, we had a nice little fun girl time. But like I said...
How are you feeling today?
I'm better today than I was yesterday, but for context... I had bone broth and crackers and like 5 French fries yesterday, and that was all I could consume.
Oh, you need like a double cheeseburger from McDonald's or something.
I couldn't even breathe without feeling nauseous yesterday. So I feel like a new person today. But yeah, I mean, how about you? What did you get into this weekend?
My wife's family was here for like the second or so week, so we hung out and. Yeah, hung out with some of her nieces.
Okay.
Guess kind of practice for my upcoming birth or
what's to come.
Child, I guess is probably the better
the little PETA.
Yeah, probably. I can remember when I was a PETA, and that's a pain in the ass for anybody that's not familiar with it. When I was little, my dad, I think, cursed me, right? He would say things like,
Don't say sorry. You'll never be sorry. And, I hope you have a son just like you.
Oh my gosh.
And this is when I was probably 6, 7 years old. So I've probably been cursed. And we'll see.
Well, yeah, time is coming real soon.
Yeah.
Dad Watch 2025.
That's right. One more month to go. But weekend was good. We had an opportunity to buy some crypto this weekend as well. Were you active in the market?
I was not active in the market. I was active in the streets.
Oh, that's right. Yeah.
So,
I mean, you do have the Tasty Trade app on your phone, Katie. I'm just saying.
I know. Well, what did I miss? Regale me.
Well, we had a bit of a dip post-Friday. You got a fairly weak jobs report, revision of prior numbers as well that didn't look too good. You've got some risk-off, tariff-on headlines, and we took a dip down towards almost 112, I want to say. Bitcoin higher now, almost 116. I've got some slides from my friends on Options Trading Concepts Live. I do that show on Mondays. So we'll go through some of these signals. We can take a look at our watch list in the Tasty Trade platform as well. But yeah, had an opportunity to, dip your toe into the water in ETH, came down to almost 33 and change. Bitcoin, like I said, 113. Solana, I think well under 160. So a nice bounce here today, and you're seeing the same thing across the market when we look at equities as well. We've got the S&P 500 up over 100 points, which gets you almost 2% to the upside. So the world was ending on Friday, and maybe today it isn't. Volatility coming back in after popping, when we look at the VIX, over 22.
Mm-hmm.
So you get a chance every now and then.
I must have missed it. Next time we've got to set up the weekend text thread so I don't miss it.
It's a good point.
But you're right. I do have both the Tasty Crypto app and the Tasty Trade app on my phone. So that's on me. But I am still optimistic. Maybe we can place a few trades, today, or talk about what we can do maybe in a crypto ETF as the market reopens tomorrow, and then maybe do something with just like one of the outrights in the next 21 minutes or so.
Yeah, let's do that. But before we do, we got to shout out the chat popping off. Emmett up in here. Katie forgot to cast her Impervious Charm.
I sure did.
Is that actually the name of a spell? I'm not really in the know. Believe it or not, when it comes to wizardry, and I don't know if I'd go so far as to say the occult, but the magic side of this spectrum, I'm not up to speed. What's the Impervious Charm?
It could be. I'm not. Also, I have not played Hogwarts Legacy in over a year or two now, so I'm a little bit slow to the specific spells. I do know that Aguamenti is a spell which would have come in real handy when I needed more hydration when I was young.
The hell is that?
It fills up your cup with water.
Oh.
Aguamenti. Yeah.
Wow, there's a spell for everything.
So I could have used that. I really could have used like Gatorade Menti, you know what I'm saying?
Something like that.
Or just some type of thing that would remove the, skull-splitting headache that I had. But here we are. We are back. But yeah, I did forget to cast that spell. I did make a wish to not wake up the way I did, and that didn't work, obviously.
Oh, I'm sorry to hear that.
But it's okay. We're here. I learned from it. I had fun. That's what do you say? You're like borrowing happiness from tomorrow to have fun tonight. Something like that.
Yeah. I guess you have to pay the price.
Yeah, the party price.
Fair enough.
Yeah.
I digress. Get your ass in the chat if you're not in there and you're not streaming this on Tasty Live's YouTube channel. What are you doing? Well, maybe you're streaming it on Tasty Live, which is a great thing as well. But if you want to join us in the chat, if you have a question for us on the show, you want to say what's up to Katie as well, get over to YouTube. We're streaming live. Pop out the chat, hit the like button, subscribe, do all that shit. I guess that's what you're supposed to say, right?
Yeah, all that shit.
Yeah, there's like this guy on YouTube that I watch. He basically provides commentary over. Now I'm exposing myself. He provides commentary over like scary videos.
Oh, hell yeah.
Have you ever seen any of this stuff?
No, but he's like, oh, I wonder what's going to happen. Like stuff like that.
It's there's a couple of these channels out there. One's called Nuke's Top 5.
Okay.
And so my wife and I watch this like while we're eating dinner. You know, it's like cell phone videos of people capturing ghosts in the woods.
Yeah.
It's great, by the way.
That sounds like such a Natalie thing, by the way. I'm so here for that.
Right, like we were kind of giving you shit about like the wizardry, and I'm over here like watching spooky videos, you know, like that Sasquatch someone captured on camera, on their grainy cell phone camera. But this other guy is called Slapped Ham is the name of the channel, and where I'm going with all of this is instead of hit the like button, he says tickle the little bell. So get over to the Tasty Live YouTube channel, tickle the little bell, and subscribe if you're not already. But that said, Katie, let's pop back over to our crypto market update. Again, these numbers are coming from the show earlier today. Options Trading Concepts Live, an hour long. You can get the commentary and the questions from there.
Yeah.
But you can see across the board, you know, consistent themes here week to week. We've got the pullback. There's not much that's up in the last week. Litecoin maybe up 2%. Everything has been down. I think it presents you an opportunity. Larger market cap tokens, things like Bitcoin and ETH, have been better places to maybe hide out versus some of the stuff that tends to be a bit more volatile. So if we jump over to smaller market cap tokens here, we got Cardano at the top. You can see double-digit losses weekly, and the same thing when we get into some of these smaller tokens. That said, that theme of Bitcoin relative outperformance remains, up 22% year to date. And then everything else against that here is in this column. So Bitcoin up 22% year to date, not against itself in that sense, just its performance. And then relative to that, ETH, it's still up, but down 15% versus Bitcoin. So up 7% year to date. Volatility is still relatively low. Price momentum remains bullish over weekly and monthly timeframes, but you have seen a bit of a pause here when we're looking at Bitcoin, ETH kind of holding in there for now, Solana a little bit worse off. Nothing that has me changing my mind, but we do want to keep an eye on whether this move evolves into something more on a weekly basis, and certainly monthly. By that time, I hope you're out, and we'll give everyone a heads up, at least as it relates to kind of what we're seeing or how I might trade it. But if I start to get a breakdown on the daily that then flows or spills over into the weekly, I'm not going to wait around for this to be down 30% on its way down to 50% if we see that show up in the monthly signals. But right now, I think, again, we were a bit overbought. We talked about that, 3,800, 3,900 ETH.
Yeah.
Looking for a pullback to 3,500. You got it. What are you going to do when you get it?
Yeah. Knowing that you've been in the game as long as you have now, are you ever fully
about to retire? Not because I won, just getting out of the game.
Give it up. Just throwing in the towel.
Right. Sometimes like your knees just hurt too much.
Yeah. Well, that's kind of what I was going to ask you is like, knowing that you've been doing this for as long as you have now, like, are you ever fully covering a position? And maybe it's less about, I'm sure the answer is no for like Bitcoin and ETH and like some of the bigger market cap coins, but like, are you ever fully covering any positions at all? And if so, like, are they in smaller names, bigger names? How do you kind of navigate that?
Yeah, absolutely. So recently, and by recently, I mean really over the last 6 months, I've consolidated my portfolio a bit within kind of a larger downtrend outside of Bitcoin, ETH. I mean, up until recently, just a couple of months ago, ETH sucked. And that was true of a lot of alts. So in some cases, I was flat or maybe slightly up from adding to positions, and then you got a little bit of a bounce, and I just took some stuff off there. That was in smaller tokens, some L2s. I was in Optimism, got out of that entirely. A ticker symbol is SEI, got out of that entirely. These are some that we don't yet offer on the Tasty Trade platform, but hopefully will soon. And as well, shout out to Andrew here. Hopefully we can get Fartcoin on the platform. That would be a good one. But yeah, I've gotten out of positions entirely because it just wasn't worth my time, attention, or when you look at the outperformance that's occurring in other areas of the market, specifically with Bitcoin, it just made sense to no longer throw good money after bad, try to buy the dip on some of the smaller stuff, and just participate in the, the broader rally across the market in some of the larger market cap tokens. So on that side of it, absolutely. On the upside, I probably will never go no coin.
Right.
You don't want to be a no coiner in a world where there's only 21 million and it's going to 10 million a coin by 2037 or whatever. You got to have a little bit of skin in the game. But I think if you were to see this cycle, some, let's call them big ass moves, I'll probably get out of a chunk, take some off the table, pay my taxes, of course, but let's throw out arbitrary numbers. ETH 10K, yeah, I'm taking some off. And I know that seems as if it's unrealistic. I think it's very possible.
Sure.
It's a non-zero probability. When we look at past cycles, if we want to use that somewhat crude analysis, I think you could get to 20,000 on ETH, maybe 30,000 if it gets really crazy. If that happens, yeah, I'm probably out. Deleted my Twitter and I'm not doing the show anymore.
You're on your private island?
Not quite that, but just taking a breather for a second. But most of the time, I am, at least at this stage in the cycle, I'm trading around some core positions. The bear markets in here can be pretty nasty, but they present opportunities to really load up. I think you have to be prudent. You've got to approach this intelligently, and you've got to take some off the table. Maybe not everything, but I think you've got to trade out of it on the other side of that. And I think you will have a chance to do that this cycle. Maybe you're already seeing some of it now, right? Bitcoin at all-time high. What better price to sell it at? Though I do think you go higher. There's a lot of indicators that could point you higher.
For sure. Okay, that's fair enough. I saw that the guy who lost his hard drive, in the dumpster.
Did you find it?
No, he's giving up. I saw. I just saw that he's throwing in the towel. So
yeah,
that's a hard one.
From what I've read, he's spent millions of dollars trying to recover this, and yeah, who knows?
That's a rough one. But yeah, it's good to know. I just wanted your 2 cents on that, because obviously it's so easy to just get greedy and want more. But you have to be sensible in terms of nibbling, pulling back a little bit, nibbling, taking some off the table.
Yeah, it's interesting with things like ETH. You can stake ETH, you can stake other proof of stake tokens, you can put them to work in DeFi. So there's a lot of utility here. So you might want to have a position in order to participate and generate a yield, right? In the same way where you might want to be positioned in treasury bonds at certain points in time. And it's not so much this trade where it's how high do you think the price of the 30-year treasury bond is going to go? How low is the yield going to go? And then are you going to trade out of that position? Or vice versa, if you have very high interest rates, are you going to go into that and then try to generate some yield? I think maybe there's some of it, but it's not so much like a binary decision when it pertains to some of these tokens that you can kind of put to work.
Yeah.
And then on the other side of that with Bitcoin, I do think today, and this is largely informed by how long I've been in this and just some of the different cycles that you've seen, I probably will hold, but there will be points where you want to take some off the table to buy it back.
Yeah.
I just won't go out of my entire position, but I could take it down 50%, 60, 70%. With the idea being, though, that I'll probably buy back in if you get some downside volatility.
Sure. So, that actually brings up an interesting point from Andrew then is are you looking at, when you're taking profits, are you doing it on a percentage of what you've invested basis? Are you doing it on a price level? Are you doing a combination of the two? So if I'm buying $500 worth of Bitcoin, is a home run being 50% of that in terms of profit, $250? What is your kind of rule of thumb for profit exits?
I look at it a couple different ways. So first of all, if that's your trade, and I think you have to have a plan going into this. If you have $500 and you're going to buy ETH and you get a 50% return on $500, that's massive.
Yeah.
Right? When you look at the nominal value, okay, it's $250, but it's a 50% return on risk. If that's not what you went into the trade for, or you didn't anticipate it, What did you go in there for? Are you looking for 1,000% return, 100% return?
Which I think is like,
you have to be realistic.
Right, which is the problem I think with like where Bitcoin or crypto volatility is right now is people see it as like this highly volatile thing where they're able to like vaporize or multiply their account, or you know what I mean? So there's just like this shift in how we talk about it so that people don't have like that type of expectation going in.
So
right?
I think a 5 to 10x is just a massive, massive home run. You can hit those more often, seemingly, in crypto.
Yeah.
If ETH goes to 30 grand from here, it's a 10x. That's a monster trade. And if you have enough in it at that time, that could be your last trade.
For sure.
So to speak. That's probably one way to look at it. It's like, what's the greediest return multiple that you can come up with that's still somewhat realistic relative to what actually happens in the space? And I think when you look at it from the perspective, okay, what market cap does that imply? How realistic is it, right? XRP at 100, probably not that realistic, so that's not my target. XRP at 10, sure. Beyond that, you might be kind of greedy. So I think you kind of just have to have some number or some idea of return in your mind, just like to go off of to start with. But in terms of how I actually do this or think about it, right? We were talking about 3,900 ETH being a little bit overbought short term, and likely we're going to see a pullback here for one reason or another. And it doesn't have to be crypto induced. It could be something that happens in other markets, which is what we saw. So I use a lot of technical indicators, right? There's not really this great kind of fundamental view that you can take for some of this stuff, right? Protocols do have revenue. You can model users, and we can look at growth trends over time. But what I typically do from a trading perspective, and you'll see this on the follow page as well, as we were kind of selling out of some positions on the way up and buying them back on the way down, I'll look at RSI. If that's in overbought territory on a daily basis, north of 80, that's one box that I'll check.
Okay.
I look at exponential moving averages, which is where we derive these price momentum signals. So when the price is above all three of the averages that I look at, and that's an 8, 13, and 22 day or period, depending on whether it's daily, weekly, or monthly for your bars. When those things get really extended, the price is very far away from even your shortest exponential moving average, your short-term time frame, and the averages themselves are quite a bit a ways from one another. That's another signal. So I've built kind of little dashboards that I use personally that'll just give me those signals. And it's not simply one thing, but when you have 6 or 7 boxes of 10 that you can check,
right,
I tend to assign a higher probability of, a reversal coming, and that's on the downside too. I've probably talked about this before from like the perspective of driving a car, or this analogy, right? And so stop me if I've said this, but we're driving the car, and our goal is ultimately to not crash the car and get to where we're trying to go. But we need to know, how fast are we going? Is it nighttime? Is it raining or snowing? Is there ice on the road? What's the traffic like? Are all the other drivers intoxicated? And so if we have a good understanding of all of these things, and we can look at this dashboard and go through and say, okay, this checks the box, this checks the box, that checks the box, then you have a pretty good sense of, whether or not it's time to get out, time to stay in, or time to enter into a position, if that makes sense. So that's kind of how I look at it. A lot of technical indicators. I want the macro fundamental backdrop too. Are we in a macroeconomic environment that's conducive to Bitcoin? Tend to be a few that are. The worst environment is one in which the data that's being reported, those economic growth metrics and those inflation data points are both going lower. You'll see the whole market crash in that environment. You'll see tech stocks down double digits. And so you just have to recognize that. You've got to recognize where you are from a price perspective. And I think you also have to have an understanding of where we are from kind of a policy perspective too. A lot of this is driven by liquidity on the margin.
Yeah.
So that all tells me today that for the most part, intermediate to long term, we're still in a pretty positive environment.
So looking at your follow trader account then, and with 4 minutes to go, like where would you place a couple shekels at this moment? if you had to pick one or two.
Let's take a look. Well, maybe we just go off of kind of what looks a little bit better here on the dashboard.
Sure.
You know, we kind of missed the dip over the weekend, or I added a couple things. I've been buying around 3,600 in ETH. Wasn't as active as I should have been below that. But
You were on niece duty.
yeah,
You have excuses.
I would kind of
Degenerate duty, okay? I have no excuses.
I'd look at ETH here. I'd look at Litecoin, Bitcoin Cash, elsewhere. You know, Chainlink has done well enough recently. Interesting dip there. We've held up. XLM is another one where you got the volatility expansion. You got the pullback here, but structurally you look pretty bullish. Hedera, HBAR is another. So we can buy like $50 of each one of these and just come back and see whether we were able to perfectly time it on Monday or not.
Yeah, why not?
All right.
Let's nibble a little.
Let's jump into the platform really quickly. We'll show you how to trade crypto on here. It's pretty easy. Just click a couple buttons for the most part. That said, Katie, if you do not have crypto trading enabled on your account, here's how you do that. Jump over to the Manage tab, and then we're looking at the web-based platform here, the web trading platform. Go to My Accounts, Trading Preferences, and you can see we've got it enabled through our third-party crypto service provider, Zero Hash. If you don't, and you have a crypto-eligible account, that means you have an individual cash or margin account, you can enable crypto trading.
Here we go.
Once you've done that, jump over here, and I think the easiest way to do this is to find a crypto watch list or type in the symbol you're looking for. And this is an easy way to also just quickly see what's up or down here, the most or the least on a daily basis. But let's go in and let's just buy $50 of a handful of coins. So let's buy some Bitcoin, and we're going to click on the ask price to do that. And we're just going to set this up so that we're going to do a dollar amount, and we'll put $50 into each one of these here.
Beautiful.
Just as an example, I suppose, of how to do this. But I also think, you know, you've got a little bit of a dip. Let's see if we can trade back to 120 on Bitcoin. That would be the high end of the 1 week, one standard deviation move, given the lower vol we're in. So we're going to buy $50 of Bitcoin. I'll post all of these on the follow page too. We mentioned ETH. We'll buy $50 worth of ETH. So we're going to jump back over to the watch list. We've got ETH on here. Let's see. Let's just sort these in alphabetical
Just celebrated
order.
its 10-year anniversary.
That's right, yeah. And ETH making a little bit more of a move here. But 10-year anniversary of ETH just last week.
Yeah. Time flies.
It sure does.
Time flies when you're still at Tasty Trade.
Right. ETH was a couple dollars at one point, right?
Yeah, we had him on the
I remember
show.
when it was $10. It's the first time I ever saw the thing at like $10. Bought a little bit and then like sold it at $100. Crazy. Now we're buying it at $37.28. We'll add a little bit of Litecoin as well. That's another one where it's just been, it's been pretty strong. Whether that continues or not, we'll see. I mean, the other thing here is that these all just kind of go up together with varying degrees of volatility. But I'm going to add a little bit of Litecoin and click on the buy. We're $3 higher than we were this morning. So I'm probably just chasing prices higher. We'll see. But, with this as well, what I like to do is just look at those 1 week, one standard deviation moves. And that'll be kind of my price target short term. So if we're just putting on some small trades like this and we're trying to return even 10% on our money would be decent.
Yeah.
And you can get that very quickly in
Cup of
crypto.
coffee in the morning.
Yeah, you don't really need leverage here given how much these can move. We're looking at Litecoin 30-day realized vol of 63%. Bitcoin Cash, let's do that one as well. BCH 562 is 553 earlier. So, getting some moves already. But, you don't need a ton of leverage when you've got this sort of volatility. And then the last one that I want to add, well, what did we talk about? XLM and Hedera. HBAR. We'll add a little HBAR.
HBAR.
And then we'll just come back and see, I don't know which one performed the best or the worst, I suppose.
Yeah. I love it.
And you know what? I haven't been in Stellar Lumens in a long time. We'll add a little bit of that.
Okay.
It's XLM, 41. I had 41.19.
A little comparison.
41.83 now. Yeah, this stuff has all moved quite a bit, as you can imagine, versus where we were this morning. But a little bit of a demonstration here on the platform.
Yeah.
So filled on all of those, you can see that right here as well on the activity page. So we got our XLM fill, HBAR, BCH, Litecoin, ETH, and Bitcoin. 6 new positions while adding to a couple positions. And yeah, if we get a little bit of a bounce here, which if I just double check my expected moves, at least for the ones that we've run, Bitcoin, I've got a range of 108.3 down to 120. That was with a spot price of 114 and implied a 37% this morning. So we'll look to get out of this. If we trade up into 120, I could get nervous and call it 118, 119. ETH, looking for almost 3,900 on that 1 week, 1 standard deviation move. And then not that we put these on, but we can run some numbers for the others. Solana, I'm looking for 178 to the upside, 149 to the downside. Sui, 394, 304 on the downside. And then XRP, I know a lot of people like to trade that. Our 1 week, 1 standard deviation move in there is 335 on the top end and 265 at the low. Now, these are not static. Obviously, they can change, but just based off our spot price this morning and implied vols or realized vols for some of these, which we'll model, those are your ranges.
I dig it. This was fun. And soon, recurring purchases coming, so you won't even have to do it manually if you don't want to.
That's right. Yeah, we've got recurring purchases for cryptocurrency going into testing, I believe today, tomorrow, one of these days. And then hopefully by mid-month, at some point this month, if we run into any bugs, that sets it back a little bit, but hopefully we don't. So that said, mid-month, targeting a release of recurring purchases. If you want to buy $50 of Bitcoin each week, like we just did here, you can set that up to automatically invest kind of dollar cost average in over time. And then, dump that position when we get to 200,000.
Yeah.
Or 500,000 or whatever your, exponential price target is.
Yeah. Oh, I've got super high expectations.
Yeah. 2037, 10 million, right?
Yeah. Yeah. Bitcoin to 500,000.
To the moon, Katie.
Yeah. By the end of the year.
Awesome. Well, thank you for coming on the show. As always, that's going to do it for our show here today. I'll be back on Wednesday with Greg Magadini of Amber Volatility. Greg's been like 4 for 4 for trade ideas. So
hot streak.
Tune into that. Yeah, he's had me looking at selling juicy puts in Circle. We talk a lot of volatility related trades in crypto, a lot of ETF options. So we were buying some ETH, cheap upside vol, looking for a 4K play. That worked out really well about 2 weeks ago. So excited to have Greg on the show on Wednesday. Don't miss that, per usual, fan favorite. But Katie, you're my favorite wizard.
Oh.
Thanks for coming on the show.
Me. Thanks so much.
I hope you feel a little bit better. By like Wednesday, you'll kick that hangover.
I'll be full force by tomorrow morning.
Hell yeah. All right, that's going to do it for our show. I'll be back on Wednesday. Until then, I'm Ryan.
I'm Katie.
Peace.